Your speaker today is Olivia Holcombe-Volke, and many of you already know Olivia. She is dynamic, she's wonderful, and I'll just say before Jeff formally introduces her, she is someone that I rely on the most at our firm. So you're in for a treat today to hear from Olivia, and Jeff, I'll let you start.
Thanks, Steve. So it's normally my job to quiet the crowd down, but Steve did that for me, so thank you, Steve. So welcome to today's Advisors Forum. It's great to have you here. We're still waiting for a few people, but we have a lot to cover today, so we're going to get started. As always, this is very casual, so please feel free to get up, get some coffee. We've got plenty of food back there. Restrooms are upstairs. We do have the form for CE credit going around, so make sure for CFPs and CPAs, if you'd like to get one continuing education hour under your belt for today, that you sign that. So that's going around right now. Our final form of the year is December 13th, and it's hard to believe it's our last one of the year, but we're at that time of year already. December 13th, same time and place, and we'll have invitations going out about a month ahead of time. We also have the delivery of our upcoming newsletter, the Elville Benefactor. That's going to be coming out in the next couple weeks, so be on the lookout for that as well. And we've also been busy at the firm getting ready for our annual client event on October 20th at Bon Secours in Marysville. So always busy at the firm, as I'm sure you are at your offices as well. So I have the pleasure of introducing today's speaker, Miss Olivia Holcombe-Volke, one of the partners at Elville and Associates. She handles all aspects of estate planning and also regularly works with clients who have elder law or special needs concerns, whether on behalf of themselves or a family member, assisting with Medicaid and veterans asset protection efforts, and the difficult issues attendant to mental and physical incapacity. She is also a volunteer attorney with the Maryland Volunteer Lawyers Service, a founding member of the Maryland Volunteer Lawyers Service Community Advocate Network, and is a board member with the Women's Law Center of Maryland. She is also the chair of the center's Judicial Selection Committee. Miss Olivia Holcombe-Volke.
Thank you, Jeff. And is the clicker for me to change?
Yeah. Make sure this works. There you go.
Great. Thank you.
You're welcome.
Well, hello, everyone. Nice to see familiar faces and meet new ones. Lucy, I'm ready for my close-up. So, some exciting times outside this week. I wasn't sure if we were going to be getting together during a hurricane. Instead, it's just dismal weather, but at least we haven't been hit full steam yet. We'll save that for this weekend. Hopefully all of your friends and family and property are going to be okay. So I'm here today to talk about charitable giving, specifically the who, what, where, when, why, and how of philanthropy. And Jeff, which button do I push to move forward?
The one on the right.
Okay. So you can't really talk much about philanthropy without at least starting with Andrew Carnegie, who of course we have to thank for such things as Carnegie Hall and Carnegie Library and Carnegie Mellon University, in addition to many other things that he founded and endowed. And this quote, "Rich men should be thankful for one inestimable boon. They have it in their power during their lives to busy themselves in organizing benefactions from which the masses of their fellows will derive lasting advantage and thus dignify their own lives." Now, I will say that in the process of looking into various Carnegie quotes, I also read criticisms of the fact that he never focused on why it was that wealth was concentrated amongst the few, but that's probably not an appropriate topic for a room full of financial advisors. So an overview of the topics that I'm going to cover, of course, taxes, which is an important part of any conversation about charitable giving, followed by different types of charitable organizations and charitable inclinations in the modern world. And that's really how I'm going to lay the groundwork. Then I'm going to cover the various types of charitable giving, what are the options, And then we'll go through a few case studies and then talk about ideas or ways in which you might add value to your client services. All right, so starting with taxes, everyone's favorite topic. What are the relevant taxes when discussing charitable giving, and particularly the new rules under the Tax Cuts and Jobs Act of 2017? And here I will be focusing on taxes as they impact the donor rather than the particular type of charitable organization. So within taxes that are relevant to charitable giving, of course, income tax is first and foremost applicable. And within that, there are the considerations of capital gain. And then what are called transfer taxes, which really refer to gift and estate taxes. And finally, a miscellaneous nuance in the Internal Revenue Code called the Section 7520 rates, which deal with charitable giving and charitable interests. So we'll start the tax discussion by talking about income tax. Under the Tax Cuts and Jobs Act, the standard deduction, as you may well know, nearly doubled. Now it is $12,000 for individuals and $24,000 for married couples filing joint. And as a result of this, there is less incentive to itemize deductions because it is more difficult to have enough itemized deductions to overcome the standard deduction amount. And this is particularly true because SALT deductions, which stands for state and local income, sales, and property taxes, deductions for those payments are now capped at $10,000. Okay, in terms of itemized deductions for charitable contributions, for gifts of cash or unappreciated property, the starting point is what type of charitable organization is this gift being made to? So for gifts of cash or unappreciated property to generally public charities or anything that is not a private foundation, you can now deduct up to 60% of your adjusted gross income, which is an increase from 50%. For such contributions to a private foundation, you can only deduct up to 30% of your AGI. For gifts of appreciated property, where capital gains is of course a consideration, gifts of appreciated property to certain charitable organizations, again, public charities, not private foundations, you can deduct the current fair market value of the property up to 30% of your AGI. For contributions of appreciated property to private foundations, you can deduct up to 20%. The good news is that if you have deductions that you cannot use, that you exceed those limits in one tax year, you can carry those forward 5 years. And one other thing that the Tax Cuts and Jobs Act did is to repeal what was called the Pease limitation, which was a rule reducing the value of higher taxpayers' itemized deductions by 3%. So that is no longer applicable. So as you can tell, with regard to available income tax charitable deductions, it is relevant what type of charitable organization you're making the donation to. Okay, so moving on to gift and estate tax. So-called transfer taxes, because of course they are assessed against the transfer of property from an owner to someone or something else. So how logical to refer to them as transfer taxes. Under the new tax law, the unified estate and gift tax exemption amount essentially doubled. It is now approximately $11.1 million per person and $22.2 million per married couple filing joint. And this is adjusted for inflation. Maryland, of course, is its own place. Maryland has no gift tax, but it does have a much lower estate tax exemption. Currently, it is $4 million for an individual, and this cannot be shared between married couples. There is no portability. In 2019, it's going up to $5 million per person, and there will be portability, so $10 million for a married couple. So with regard to available transfer tax charitable deductions, gift and estate tax, the classification of whether the charitable organization is a public charity or a private foundation is not a relevant consideration. And then, as I said, there is this miscellaneous tax provision that is relevant to charitable giving. The Section 7520 interest rates, these are used to value certain charitable interests that are held in trusts, such as charitable gift annuities, charitable remainder trusts, and charitable lead trusts, all of which I'm going to talk a little bit more about. The rates of the Section 7520 interest rates do vary monthly, and fluctuations in them can have dramatic effects on the amount of income or transfer tax charitable deductions available. So talking about charitable organizations, are they all the same? This, as I mentioned, is a relevant consideration with regard to tax considerations. As set forth above, the type of charitable organization can have an impact on income tax deductions. According to the IRS website, of course, irs.gov, public charities generally receive a greater portion of their financial support from the public or from governmental entities, and generally have greater interaction with the public. A private foundation is typically controlled by members of a family or a small group of individuals and derives much of its support from a small number of sources or purely from its own investment income. And actually, a 501c3 organization is presumed to be a private foundation unless it specifically requests and qualifies for treatment as a public charity. Now, moving beyond tax and talking briefly about what are charitable inclinations in the modern world, because the reality is that no one gives to charity purely to get a tax deduction. So some of the reasons for charitable giving, of course, religion is a significant one, public recognition or self-image, appreciation of the organization's work or an emotional connection to the organization's work, the desire to leave a legacy or having a family value of charitable giving. Some people do not want to transfer substantial wealth to their descendants. The desire to give back to the community, or for some people, they don't have any descendants to leave their wealth to. So what are the types of charitable giving? Well, volunteering and outright donations of property are, of course, the most well-known. But there are also charitable giving devices called charitable gift annuities, charitable lead trusts, charitable remainder trusts, private foundations, charitable giving using retirement assets, which is something we're all familiar with, and donor-advised funds. So I am going to go through those a bit more specifically and talk about the tax applications of each of them. Bless you. So talking about volunteering and outright donations, this can include donating clothing, cars, other types of property, making random cash donations, or making regular cash donations. The tax applications of this type of charitable giving are basically you have to itemize. And itemized deductions, as I mentioned before, can be difficult to have a sufficient amount to overcome the standard deduction amount. There is one option to get around this, which is called bunching, which means making 2 or more years of charitable donations within 1 year, and thereby having a sufficient amount of itemized deductions to add up to more than the standard deduction amount. And then over the next few years, going back to relying on the standard deduction. Unfortunately, this is not good for the charity because it does make it difficult for them to budget or know what to rely on for their finances for the year. For gift tax purposes, there is no gift tax consequence for volunteering or making outright donations. And for estate tax purposes, of course, there is an estate tax charitable deduction available for charitable gifts made at death. This is really good for clients who have charitable inclinations but not a lot of wealth, or for clients who have charitable inclinations and do not desire to give away their wealth. So moving on to a bit more complicated of a charitable giving technique, a charitable gift annuity. So what is this? Well, it's a contract between a donor and a charity. The donor donates property to a charitable organization in exchange for an immediate partial income tax deduction, plus a fixed stream of income for either the rest of the donor's life or someone else's life, or joint lives for a married couple, after which the charity receives the remainder of the gift. The tax applications of this type of charitable giving device, for income tax purposes, the donor can take an immediate income tax charitable deduction for the full fair market value of the asset minus the present value of all the annuity payments expected to be received. On the annual payments themselves, if cash or unappreciated property is donated, a portion of the annual payment will be a tax-free return of principal, and a portion will be subject to ordinary income tax. If appreciated property is donated, this is treated as a bargain sale. That is what the IRS looks at this as. It is partially a gift and partially a sale. So in that case, a portion of the annual payment will be a tax-free return of principal, but a portion will be subject to ordinary income tax and the capital gains tax. But the capital gains will be spread out ratably over the annuitant's lifetime. Now, if the donor is not the annuitant, the capital gains tax cannot be spread out and is therefore due all at once. If the annuitant happens to live beyond the life expectancy under the annual mortality table, 100% of the payments received thereafter are subject to ordinary income tax. And here, the impact of Section 7520 rates. A low Section 7520 rate reduces the available charitable deduction for the initial gift, but increases the amount of the annual payments that will be excluded from exposure to ordinary income tax, which is called the exclusion ratio, and vice versa. For gift tax purposes, if the annuity is providing payments to someone other than the donor, of course there can be gift tax consequences, but a gift tax charitable deduction is allowed for the difference between the fair market value and the sales price, i.e. the amount that is ultimately going to the charity. For estate tax purposes, the contributed property is removed from the donor's estate. The pros of this type of charitable giving device are the simplicity. It is simple to establish and simple to understand. The ability to rely on fixed payments or a fixed stream of income is appealing, and this will be true regardless of how poorly the investments in the annuity perform. The ability to donate many different types of assets can be appealing for this type of charitable giving. The immediate income tax charitable deduction and the annual portion of your income that is tax-free, and the ability to reduce and spread out capital gains tax. Those are all appealing. A charitable gift annuity is similar to a charitable remainder trust, which I will talk about a bit later. But these are not subject, charitable gift annuities are not subject to the private foundation rules and restrictions that do apply to charitable remainder trusts. The cons to a charitable gift annuity are, first and foremost, if the institution fails, you are out of luck. So you want to make sure that you only establish a charitable gift annuity with an institution that has a proven track record. The amounts of the annuity payments will not increase or adjust for inflation or if the market does well. It cannot be for a term of years. It has to be for a lifetime. And it cannot be used to support multiple charities at one time. And a charitable gift annuity can only be with one charitable organization. So a charitable gift annuity is really good for planning for retirement or future financial security, and for assets that really aren't suitable for a charitable remainder trust, such as tangible personal property. And that I will talk about again later.
Can we ask questions now?
Sure.
So can this be for two lives? Can spouses?
Yes.
And then who determines any kind of interest rate related to this? Is there a IRS interest rate?
Yes, exactly.
Okay.
It's the IRS section 7520.
Okay. Regardless of the type of asset.
Right.
Okay.
Okay, so moving on to charitable lead trusts. So what is this? It's an irrevocable trust that makes fixed payments to one or more charities for a set amount of time or for someone's lifetime, after which the balance is paid to one or more family members or other non-charitable beneficiaries, which can include the grantor. There are two main types of charitable lead trusts. A charitable lead annuity trust, which is called a CLAT. This is where the charity receives a fixed payment amount annually. Or a charitable lead unit trust, or a CLUT, where the charity receives a fixed percentage of the total trust assets annually. The tax applications. For income tax purposes, the tax applications of a charitable lead trust depend primarily on whether it is treated as a grantor or a non-grantor trust. So starting with a grantor charitable lead trust. In this case, the grantor can take an immediate income tax charitable deduction for the present value of all payments that will be made to the charity. But the trust's investment income will be taxable to the grantor during the charitable lead term. And the grantor cannot take any charitable income tax deduction against that. The flip of that is a non-grantor charitable lead trust. In this case, the grantor cannot take an immediate income tax deduction for the present value of all payments to the charity, but they are also not taxed on the trust's investment income. That is taxed to the trust, and the trust is exempt from income tax. So the growth in the trust is tax-free. For gift tax purposes, if the remainder interest is to go to someone other than the grantor, there will be gift tax consequences. But the property contributed to the trust will be eligible for a gift tax charitable deduction equal to the present value of the interest going to the charity, and it is actually possible to create what's called a zeroed out charitable lead trust, where the charitable interest is equal or nearly equal to the value of the property transferred to the trust, resulting in a 0% gift tax consequence. And, as I mentioned, any growth or appreciation in the trust will not incur gift tax. For estate tax purposes, the property contributed to the trust will be considered part of the grantor's estate, valued at the time the trust was funded. But the grantor's estate will be eligible for an estate tax charitable deduction for the value of the interest paid to charity. And any growth or appreciation in the trust will not be considered part of the grantor's estate. So the pros of this type of charitable giving device are that any appreciation or growth of trust assets is not exposed to estate or gift tax. There is no time limit, minimum or maximum, for the charitable lead term, for the number of years that the charity gets paid out of the front end. There is no required minimum or maximum annual payment amount to the charity. Additional contributions can be made, but only to a CLUT, which again is a charitable lead unit trust. And you are able to donate various types of assets. The cons to this type of charitable giving device are the cost to establish it and the ongoing maintenance costs. It is irrevocable. The grantor loses access to the trust assets and any income they may generate during the charitable lead term. And lead charities cannot be changed over time. They are fixed as of the establishment of the trust, One variation on this, one way to kind of maneuver around that, is to actually name a charity for the charitable lead term that sponsors its own donor-advised fund. This way, the grantor will still be able to direct distributions from the donor-advised fund to charities of the grantor's choosing and can change those over time. This is a really good device for donors who have charitable inclinations and who also have sufficient other assets to survive in the meantime, and the ability to defer the receipt of assets by their non-charitable beneficiaries. It is good for common stocks and other appreciable assets because the growth and appreciation is removed from the estate. So moving on to the reverse of the charitable lead trust, which is the charitable remainder trust. So this is an irrevocable trust that makes payments to one or more family members or other non-charitable beneficiaries, which can include the grantor, for either a set amount of time, the maximum of which is 20 years, or for the life of the non-charitable beneficiaries, after which the remainder is paid to one or more charities. The value of the charitable remainder upon the creation of the trust must be at least 10%. So at the time of creation of the trust, the value that's ultimately going to the charity has to be at least 10%. Again, there are two types. The Charitable Remainder Annuity Trust, or CRAT. Aren't we having fun with these acronyms? This is where the non-charitable beneficiary receives a fixed payment amount annually, versus a Charitable Remainder Unitrust, that's right, a CRUT, and this is where the non-charitable beneficiary receives a fixed percentage of the trust's assets annually. The annual payments must be at least 5%, but no more than 50% of the trust's assets. For CRATs, where it's the annuity payment, this is calculated based on the trust's initial value. For CRUTs, where it's a percentage of the total trust assets, this is recalculated annually. The tax applications for a charitable remainder trust, for income tax purposes, the grantor can take an immediate income tax charitable deduction for the value placed in the trust minus the present value of the annuity or unitrust payments. On the annual payments themselves, the non-charitable beneficiary will pay income tax on the income received. Section 7520 rates, in combination with the 10% rule, can impact who is allowed to be a non-charitable beneficiary, basically how long their life expectancy is. A hallmark of this type of trust is the avoidance of capital gains tax. If the trust sells appreciated property, it is exempt from capital gains tax, and it can then reinvest the full amount of the proceeds. For gift tax purposes, if the grantor receives the annual payments, there is no gift tax. If someone else receives the payments, generally there is gift tax. And for estate tax purposes, if the grantor received the annual payments, the trust is included in the grantor's estate, but there is a charitable deduction for the full amount of the trust. If someone else receives the payments, the trust assets will generally not be included in the grantor's estate. So the pros of a charitable remainder trust. If it is a CRUT, additional contributions can be made to the trust over time. The remainder charities can be changed over time. It can be funded with various types of assets. And of course, first and foremost, the avoidance of capital gains tax is a big pro of a charitable remainder trust. There is the income tax deduction and the income stream. The cons are, again, the cost to establish the trust and the ongoing maintenance costs. This is a good type of charitable giving device for appreciated assets and as the beneficiary of qualified retirement assets, which I will discuss further. All right, so the private foundation, which is the opposite.
You said you were going to explain the difference between charitable gift annuity and the CRAT. I'm still a little confused between those two. They seem very similar to me. Charitable gift annuity and private.
They are very similar. Some of the distinctions are, so one distinction which in my case study, one of the case studies I'm going to go over with you, it'll exemplify it, but with regard to tangible personal property, often a charitable remainder trust is not a good device for that type of contribution, simply because there's no appreciation necessarily, and there's nothing that's really going to be earning income. That can often be used well for a charitable gift annuity. If you make that with a museum where they're happy to receive a piece of art that they know eventually will be part of their collection, that can work well for a charitable gift annuity. The other is the difference between charitable remainder trust can have some limitations with private foundation rules that are not applicable to charitable gift annuities. Sure. So private foundations. As with a public charity, a private foundation must be operated for public purposes, such as religious, charitable, scientific, literary, or educational. But a private foundation generally makes grants to other charitable organizations rather than actively conducting charitable programs and services of its own. Generally, as I said before, a private foundation is endowed by a single individual or a family, a corporation, or a small group of private donors. And the ongoing funding of a private foundation is derived primarily from its investment income and growth in its underlying assets rather than fundraising. Because of the lack of public oversight and participation, private foundations are much more closely regulated under the Internal Revenue Code to safeguard against use for private benefit rather than for charitable purposes. The tax applications. For income tax purposes, a donor can take an immediate income tax charitable deduction for the full fair market value of the contributed asset. But remember, there is a lower charitable deduction amount allowed for donations to private foundations. 30% of gross income for cash or unappreciated property, as opposed to 60% when the same thing is donated to a public charity. And 20% for appreciated property, as opposed to 30% when donated to a public charity. Yes?
So a public and a private can both be 501c3, but it's really how they operate or how the IRS determines they operate, right?
Exactly.
Okay.
Exactly. Okay, so for gift tax purposes, no gift tax will be incurred for contributions made to a private foundation. And for estate tax purposes, the donor's estate will be eligible for an estate tax charitable deduction for the amount of the bequest. So what are the pros? Well, the positive side to a private foundation is that it does provide a donor with the maximum degree of control and flexibility regarding the use of assets for charitable purposes, both during life and after death. A donor can outline a comprehensive giving program which can be modified over time or left to the discretion of the foundation's governing body. And private foundations can carry out activities beyond traditional grant making, such as mission or impact investing and program-related investments. The cons are, of course, the lower allowable income tax charitable deductions. There is an additional tax on net investment income for private foundations, and they do have exposure to excise tax. And they are subject to more restrictive operating rules. So this is really a good tool for creating and sustaining a family legacy approach to charitable giving. Now, one nuance, which speaks to your question, so of course there has to be complication because why not? So for income tax charitable deduction purposes, there are two types of private foundations that are treated the same as public charities. The first is called a private operating foundation. This operates their own charitable programs rather than making grants to public charities. That's a private operating foundation. A conduit private foundation distributes an amount equal to 100% of all the contributions they received in the taxable year. And those two types of private foundations are treated the same as public charities.
So the
for tax
conduit
purposes.
couldn't have an endowment.
Right.
Okay.
It wouldn't, it could have an endowment that grows, it's just that any contributions would then have to be distributed out in that year.
Right.
Okay. Okay, so talking about retirement assets, and as I said, I believe this is something that has come across most of our desks as a counseling opportunity for clients, what to do with retirement assets, particularly in light of taxes. So I will talk about lifetime opportunities and after-death opportunities for how to make charitable contributions using retirement assets. The lifetime opportunities, if an IRA owner is 70 and a half or older, they can transfer up to $100,000 from a traditional IRA, not a 401k, to charity each year. This is called a qualified charitable distribution, or QCD. The tax applications, the charity is of course exempt from income tax, and the distributions therefore won't be added to the donor's AGI, and thereby avoid higher AGI with potential for high income surcharge for Medicare Parts B and D, and holding down the percentage of the donor's Social Security benefits that are subject to tax. There is no gift tax consequence, and the distributions will be removed from the donor's taxable estate. The pros, of course, are that number one, this will count as the required minimum distribution without actually being added to AGI, and thereby will minimize tax exposure. The cons are that the donor does not get to benefit from the use of the distributions. So after death, naming a charity as the beneficiary of a qualified retirement asset, the charity is exempt from income tax, and this removes the value of the entire asset from the donor's taxable estate. The pros, of course, are that it will minimize tax exposure. The cons are that other beneficiaries will not benefit from the use of the asset. But there is one planning variation on this. So name a charitable remainder trust as the beneficiary of a qualified retirement asset. The donor's estate receives a charitable deduction for the value of the interest that will pass to charity. The trust is tax exempt, so it will not owe income tax on the receipt of distributions from the retirement asset. And the other non-charitable beneficiaries will still benefit from distributions from the charitable remainder trust during the non-charitable term. Donor-advised funds. These are not separate charitable entities. These are rather a segregated fund or account that is maintained through an existing 501c3 public charity to which a donor or small group of donors can make contributions while still retaining an advisory role with respect to the distribution and or the investment of the assets. This is often available through financial services firms, independent groups, community foundations, and single-issue charities. There are various minimums to establish. Some funds do set limits on subsequent contributions. Some set a minimum amount per grant or specify how many years can pass before a donor actually makes a grant. Some allow donors to make grants to any eligible 501c3, and others impose certain restrictions. The donor makes the initial contribution to the fund. The money is then invested in a variety of growth, balanced, conservative, or socially responsible investment pools where it can grow tax-free. The pros are that the donor can deduct the entire contribution in the year made, but can then dole out grants over time to various organizations. Donor-advised funds are flexible about the type of donations they will accept. They even accept Bitcoin. Donor-advised funds can be multi-generational. Donors can appoint their children as advisors or successors to the fund, and the fund will handle all record keeping. The cons are, again, the costs, the annual administrative fees, and the expenses for the underlying investments. So now I'm going to go through a few case studies. And this one, I cheated. I already gave you the answer here. So, client has a valuable painting which she intends to leave to the Museum of Art at her death. Having recently retired, she is concerned about having sufficient income to travel and play while she is still in good health. What should she do? Well, a charitable gift annuity with the Museum of Art will allow her to gift during life that which she intended to leave to them at death anyway, and in exchange, she will receive and benefit from a fixed income stream while also receiving an income tax deduction. The next one's up to you guys to guess. All right, case study number 2. Client has sizable assets and charitable inclinations that he wishes to fulfill and see some benefits from during his lifetime, while also wanting to ultimately benefit his daughter in the future. Any thoughts? You're forgiven.
Lead trust, right?
What'd you say?
Lead trust?
That's exactly right. So using a charitable lead annuity trust, the client can actually transfer slightly more than $1.5 million to the trust with a payout of $100,000 per year for 20 years to his favorite charity. Depending on the Section 7520 rate, the client may be entitled to a gift or estate tax charitable deduction equal to the full value of the assets transferred, so equal to $1.5 million. And with a rate of growth of 6 to 7%, it may result in a transfer of closer to $2 million to his daughter without any gift or estate tax.
Now, question back here.
Yes.
Going back to case study 1, where's the liquidity going to come from? She donates that painting to the museum. Where's the liquidity going to come from to give her that annuity for the rest of her life?
Well, I think with the Museum of Art example, it's just something that they would be willing, if it was a painting that they were
Going to buy anyway, right?
going to buy anyway,
Yeah.
or going to then be able to possibly transfer to make a gain at some point. I mean, that ends up becoming an asset of the Museum of Art. So the value of the painting is something that they're then basically making payments ahead of time or making payments on over time to her. So it is still an asset for their purposes. So even though it's not an investable asset, it's an asset for the purposes of the Museum of Art.
So during this transfer, she would need to make some sort of agreement with them that this painting is worth $1 million. I'll take $500,000 over my lifetime.
That's right, absolutely. I mean, that would be the contract that they would
Right.
that they would agree to.
Okay.
Okay, case study number 3. Client wishes to provide for both her surviving spouse and a charitable organization at death. She has a variety of assets, including a qualified retirement plan. Any thoughts?
You make the beneficiary, it's a remainder trust, but you make the beneficiary the trust, and the remainder goes, maybe not.
Yeah, you're on the right track. So,
Yeah.
exactly, you're
Yeah.
headed the right direction. So,
Yeah.
first step is she could just very simply designate her qualified retirement plan to charity and thereby fulfill her charitable goals. And her estate would receive a charitable deduction, and her spouse would inherit the other assets that don't have income tax consequences. But even better, the client could create a charitable remainder trust, designated as the beneficiary of the qualified retirement asset, thereby permitting her surviving spouse to receive benefits from the retirement asset tax-free while still ultimately
That's what I
benefiting
meant.
the charity. Exactly. Well done.
Olivia, how is the spouse going to receive retirement 401k assets tax-free?
So the charitable remainder trust, the charity gets the remainder, but there's a term of years or a lifetime during which a non-charity gets a stream of income.
But that's taxable, that's tax advantage, that money's not been taxed.
Well-
Retirement assets.
That's true, but it would be,
That would be ordinary income to the spouse.
it's a good challenge to throw my way. So, let's see.
Because we do charitable remainder tax returns in my firm.
Sure.
So I see this sort of thing.
This sort of thing. All that and Steve, I don't know if you have any input on that, but my thought is that it would just simply be at a lower income tax rate than if they were receiving directly from the retirement asset. But when you prepare these retirement returns or retirement tax returns, maybe you see something different. What do you think, Steve?
I'm just thinking that that material maybe has come from McGuire Woods and Richmond.
Yes.
And they must have a way of doing that, is what my sense is. And what you may be saying there is that because the IRA goes to the charitable remainder trust, that it is received by the charitable remainder trust tax-free initially, and therefore the distributions go out that would have been taxed otherwise, but when they are received by the spouse, I think that's the question, is that going to be taxable income after it's distributed? It's not taxable to the charitable remainder trust, but is it taxable when it comes out to him in the end? So that's something we can get back to.
Right, the character of that income remains the same. Even though it flows through the trust, the character of that income remains the same.
Okay.
And in this case, it's ordinary income because it's retirement assets.
Well, so yes, I will investigate further.
Yes, we'll get back to it.
Absolutely. To all of you, I will let you know. So case study number 4. Clients are married and have 4 adult children and 10 grandchildren. Clients have a mid-sized estate, charitable inclinations, and desire an opportunity for creating a family legacy of charitable giving that will include their children and grandchildren without the burden of the regulatory compliance and paperwork that comes with creating a private foundation. They also want to ensure that their trusted financial advisor can continue to manage all of their investable assets. Sounds good, huh? So any thoughts?
Donor advised.
Yes, exactly. By establishing a donor-advised fund through their local community foundation, clients are able to achieve their goals of lifetime giving in a way that allows their children and grandchildren to contribute as they are able, with everyone having a say in which charitable organizations will receive grants, while also maintaining all investments under the skilled management of their financial advisor. Which leads us to ideas for adding value to your client services. So for your clients, it can help to start by understanding the why behind charitable inclinations. And then you will be better able to help guide them to the what and the how. From the 2016 U.S. Trust Study of High Net Worth Philanthropy, the greatest challenge faced by donors is identifying causes they care about and where to donate. This is followed by how much they can afford to give, allocating time to volunteer, monitoring giving to ensure it has its intended impact, and structuring gifts in a tax-efficient manner. One idea is for you to start your own 501c3. Benefit a cause of your choosing and provide an easy opportunity for your clients to contribute. You may all have heard of the Elville Center for the Creative Arts. Connect with the Community Foundation. Howard County has a fabulous one, the Community Foundation of Howard County. It is a public charity. It does offer donor-advised funds and lifetime income stream options, and it has a financial advisor program, allowing financial advisors to continue management of their clients' funds. Know the particular needs and options for giving in your county or region. Offer opportunities for impact investing, and familiarize yourself with some of the tools available to help guide clients with charitable inclinations, to know what their options are for volunteering, for safe charitable organizations to give to. Some excellent websites that offer these sorts of guides are givewell.org, guidestar.org, charitynavigator.org, And the Better Business Bureau has a Wise Giving Alliance, give.org. And finally, of course, something that we all know, but it never hurts to repeat, is advising clients to avoid clicking on links in unsolicited emails or responding to unsolicited calls, and to even approach with caution such websites such as GoFundMe and Kickstarter because of the fees involved and the potential for abuse. And that concludes my presentation on charitable giving. Thank you so much.
Olivia, there might be more questions, I don't know. I'll just say one of the things that always amazes me is that not everyone gives for some kind of financial benefit. You know, people are driven many times by their hearts and minds and not by tax implications, but many people are. That I'll just throw it out there.
And
That's a significant thing to take away.
Yes, and I agree with you. And of course, tax deductions never hurt. No one is unhappy to have that, but it is true that that's not always the guiding principle. Has any other questions? And I will get back to everyone with regard to Paul's question. Thank you.